You've probably seen those posts saying, just invest $10 a day and retire rich. Sounds nice, until you realize most people following that plan end up asset rich but cash poor. They have big accounts, but tiny paychecks. The problem isn't that they're investing wrong, it's that they're investing in the wrong kind of growth. In this video, I'm fixing that. I'm going to show you and Josh why so many investors default to the S&P 500 and why that comfort zone might hold you back. Then we will see why simple portfolios almost always beat complicated ones, and the 5 rules I use to filter the strongest ETFs from the noise. And in the end, I'll show you how the combined portfolio of these 3 ETFs can outperform the S&P 500 in total value, adding an extra $700,000 to your portfolio and even beat your full-time job by paying over $15,000 in monthly dividend income. But first, let's see. Why do most investors default to the S&P 500? The S&P 500, it's the most recognized, most trusted investment in the world. For millions of people, it's the first and last ETF they ever buy. And on the surface, it makes perfect sense. It's simple, diversified, and historically strong. If you just own the market, you win, right? Well, not exactly. Let's look at what's really inside the S&P 500, specifically the SPY ETF which tracks it. On paper, it holds over 500 companies, which sounds super diversified, but when you look closer, almost 38% of your money is actually sitting in just 10 names, mostly the tech giants: Nvidia, Apple, Microsoft, Amazon. In fact, more than a third of the entire fund is tied to the tech sector alone. That's not true diversification. That's like thinking you've got a buffet when really, most of your plate is just one dish. And while SPY's growth has been impressive, its income hasn't kept up. The dividend yield is only around 1.1%, which means if you had $1 million invested, you'd earn just $11,000 a year in cash flow. That's not financial freedom, that's financial patience. The S&P 500 works well for building wealth over decades, but it doesn't pay you to live along the way. It's designed for growth, not income. So here's the question. If SPY gives you and Josh exposure to the economy, what gives you exposure to freedom? That's where a lot of people get stuck. They think adding complexity is the answer. But actually, the opposite is true. Simplicity, when it's structured the right way, can do more than just build wealth. It can accelerate it. The investing world is addicted to complexity. Every day there's a new ETF launch, a flashy strategy, and some expert predicting the next big move. But here's the thing, complexity doesn't create better results, it creates chaos. ETFs are designed to simplify investing, to give you diversification, efficiency, and growth in one simple package. Yet most people turn them into a mess. They buy too many, overlap their holdings, trade too often, and end up with a portfolio that looks busy but performs average. The truth is, simplicity almost always wins. The fewer moving parts you have, the more control you gain. You don't need 15 ETFs across every niche of the market. You just need a small, well-structured system that covers income, stability, and growth. 3 forces that compound together over time. And that's exactly what this 3 ETF system is built around. Clarity over confusion, consistency over chaos. Before we jump into the specific ETFs that make it work, let's quickly walk through the 5 simple rules that shape this strategy, the same filters I use to separate strong, reliable ETFs from everything else. If you've ever tried to pick an ETF, you know how overwhelming it can be. There are thousands of them, all with fancy names, sharp marketing, and charts pointing upward. Some promise high dividends, others focus on growth, and a few try to do everything at once. But here's the truth, most of them add noise, not value. The real power of ETFs isn't in chasing the newest trend, it's in choosing the right structure. When I built this system, I didn't look for what was popular, I looked for what was proven. That led to 5 simple filters, timeless principles that separate strong ETFs from the rest. First, the ETF has to pay you for owning it. A solid dividend yield means you're partnering with companies that actually make money. Second, that income has to grow. Getting paid once is nice, but getting a raise every year is how you build freedom. Consistent dividend growth shows financial health and leadership discipline. Third, it needs steady price appreciation. That's what multiplies your compounding. It's what turns a good portfolio into a great one. Fourth, the ETF should be efficient. Low fees, low turnover, and no unnecessary drama. And finally, true diversification. Not hundreds of similar companies moving in the same direction, but different sectors, geographies, and business cycles, balancing one another like gears in motion. When those 5 elements combine together, yield, growth, appreciation, efficiency, and diversification, you get a fund and a system that compounds and works together better than anything. All right, let's start building this thing. And every solid structure needs a foundation. In this strategy, that foundation is SCHD, also known as the Schwab US Dividend Equity ETF. This ETF is designed around one clear idea: own the strongest US companies with a consistent record of paying and growing dividends. These aren't speculative tech startups or one-hit wonders. They're proven profit machines, businesses. Let's take a look at what SCHD is holding inside. Companies like AbbVie, Lockheed Martin, PepsiCo, Merck, and Chevron. The same names that have carried American portfolios through recessions, interest rate hikes, and everything in between. And the balance across sectors is part of what makes it so steady. About 19% is in consumer defensive stocks, 18% in energy, 16% in healthcare, 10% in industrials, and just under 10% in technology. That mix gives you a nice blend of stability and growth without putting all your eggs in one basket. Now, let's talk about numbers. SCHD currently yields about 3.9%, nearly 4 times what you'd get from the S&P 500's 1.1%. But the real strength isn't just in the yield, it's in the growth of that income. Over the last decade, SCHD's dividend payout has climbed at an impressive 10.43% annual growth rate. That means your cash flow is outpacing inflation. Every year, you're effectively giving yourself a raise. In terms of risk, SCHD stays disciplined. Its annualized volatility sits near 16%, lower than many growth ETFs, with a tracking error around 10%, meaning it's steady, predictable, and not prone to wild swings. SCHD is the workhorse of this system. It anchors your portfolio with real income and reliable growth. Now that SCHD has your income covered, the next step is balance, and that's where INTF comes in. INTF stands for the iShares International Equity Factor ETF. It's designed to give your portfolio global reach, owning strong established companies from Europe, Asia, and Canada instead of keeping everything tied to the US. While SCHD focuses on America's best dividend payers, INTF spreads your money across hundreds of dependable businesses around the world. That way, your results aren't tied to just how one country's economy is doing. It's spread across nearly 500 companies from Europe, Asia, and Canada, giving you a slice of the world's most dependable corporations, from Novartis and Nestle to ASML and SAP. These are global titans that don't rely on the US economy to thrive, so when American markets slow down, your portfolio doesn't necessarily have to. Sector-wise, INTF leans into balance and durability, with about 25% in financials, 19% in industrials, and strong exposure across consumer cyclical, healthcare, and technology. This diversification means that when tech-heavy markets stumble, industrials and banks often pick up the slack, smoothing out volatility without sacrificing returns. The beauty of INTF lies in its design. It doesn't blindly follow an index. It selects companies based on proven success factors, strong balance sheets, stable earnings, and solid valuations. This factor-based approach filters out the noise, leaving you with stocks built for consistency rather than speculation. INTF's dividend yield sits at 2.78%, which might sound modest until you see what's behind it. Over the last decade, it's grown those dividends at an extraordinary 19.36% annually. And it does all that without taking wild risks. INTF's volatility is among the lowest in its category, and no single company makes up more than about 2.5% of the fund. That keeps things stable and balanced, exactly what you want from the steady piece of your system. With an annualized volatility of around 16.8%, it's one of the most stable performers in its category. But every strong portfolio needs acceleration, something that captures innovation, speed, and the kind of growth that reshapes your future. That's where QQQ, the Invesco QQQ Trust ETF, comes in. In a couple of minutes, I'll show you how to build a portfolio using these 3 ETFs, and by the end, you'll see how they can outperform the S&P 500 in total value, adding an extra $700,000 to your portfolio, and even beat your full-time job by paying over $15,000 in monthly dividend income. But first, let's quickly go through QQQ. This ETF tracks the NASDAQ 100, which includes some of the most influential companies driving global innovation. Inside, you'll find names like NVIDIA, Microsoft, Apple, Amazon, Meta, Tesla, Alphabet, and Netflix, the businesses shaping technology, AI, cloud computing, and everything that defines the modern economy. It's a fund that leans heavily into technology, over half of its holdings, with the rest spread across communications, consumer sectors, and a bit of healthcare. It's not built to be defensive, it's built to grow. The dividend yield is small, around 0.5%, because these companies reinvest most of their profits into developing new products and expanding their reach. The ETF's volatility sits around the 23.5% mark, making it the most dynamic of your trio. This is not the ETF for comfort, it's the ETF for growth. SCHD and INTF give you income and balance, QQQ gives you velocity, speed, and momentum. And when you bring all three together, they start working like a team, balancing each other's strengths and weaknesses. When you combine ETFs, the real question isn't how many do I own, it's how different are they? True diversification isn't about holding more funds, it's about holding funds that actually behave differently. That's what makes this trio, SCHD, INTF, and QQQ, so effective. Even though all three are equity ETFs, their overlap is surprisingly low, which means each one brings something unique to the table. Between SCHD and QQQ, the overlap is only around 5%, with just a few shared names like Cisco, PepsiCo, and Texas Instruments. Beyond those, they go in completely different directions. SCHD focuses on steady U.S. dividend payers, companies that generate strong cash flow and reward investors consistently, while QQQ leans into high-growth innovators that reinvest profits for expansion. Then there's SCHD versus INTF, and here the overlap is basically zero. INTF owns international leaders like Novartis, ASML, Nestle, and SAP, companies you won't find in SCHD. This gives you true global diversification, balancing your US-based income with growth across Europe, Asia, and Canada. Even QQQ and INTF don't share holdings, which keeps your exposure fresh and balanced. QQQ captures American innovation. INTF captures strength outside the US. They move differently, and that's the whole point. Put together, these three ETFs cover different regions, sectors, and business cycles. Together, they only have 5% overlap. That is only 6 companies. So when one market slows down, another often picks up the slack. It's a structure built to smooth out volatility while still letting your wealth grow steadily over time. When you put any ETF strategy to the test, there's only one benchmark that truly matters, the S&P 500. Represented by SPY, it's the bar everyone measures against. But what happens when a carefully designed trio of ETFs, SCHD, INTF, and QQQ, is stacked beside it? Over the past year, markets have been anything but calm. Between inflation, rate hikes, and supply chain issues, volatility was everywhere. Even so, QQQ led the way with about a 21% gain, boosted by massive growth in AI and tech. INTF came in strong with roughly 15%, helped by rebounds in international markets and financial stocks. SPY, the benchmark, landed around 13%, which is solid, but both QQQ and INTF edged it out. SCHD, on the other hand, had a rougher stretch, down about 7% as investors moved away from dividend-heavy sectors. But that's where diversification proves its value. While SCHD cooled off, QQQ and INTF picked up the slack, keeping the overall portfolio balanced and moving forward. Zooming out the last 5 years tells an even clearer story. QQQ more than doubled investors' money with a 104% return. SPY followed at around 89%, while SCHD and INTF posted gains of roughly 37 and 43%, showing consistent performance through very different market conditions. Blended together, these three ETFs create something that a single fund like SPY can't easily match, a mix that plays offense and defense at the same time. When growth stocks soar, QQQ carries the weight. When global markets rebound, INTF contributes. And when things get volatile, SCHD's dividend strength helps cushion the ride. So, rather than relying on one market or one style, you get a smoother, more resilient path to long-term growth. Now, let's bring all three pieces together and look at how they form one balanced, intentional strategy. The structure is straightforward: 40% SCHD, 40% INTF, and 20% QQQ. Each piece plays a clear role, and together they cover all the major pillars of long-term investing. The first 40% in SCHD gives you a solid base of dividend-paying U.S. companies. It's the engine that generates steady cash flow and keeps reinvesting it back into your portfolio. The next 40% in INTF spreads your reach beyond the U.S., across Europe, Asia, and Canada, balancing out your exposure to different economies and currencies. That global layer helps smooth out volatility and keeps your portfolio from being too dependent on one market. The final 20% in QQQ brings the acceleration. It's your growth driver, exposure to the world's leading technology and innovation companies that push your returns higher over time. Here's what the full picture looks like when everything comes together. SCHD, the income cornerstone, yields 3.9% with a 10-year dividend growth rate of 10.43% and annual share price appreciation of 7.82%. Reliable, consistent, and built for stability. INTF, the global stabilizer, adds a 2.78% yield, but really stands out with a 19.36% 10-year dividend growth CAGR and 4.03% price appreciation, expanding your reach beyond U.S. markets. And then there's QQQ, the innovation engine, offering a low 0.48% yield but an explosive 18.98% annual price appreciation. Pure acceleration. Together, this 3 ETF portfolio averages a 2.77% dividend yield, a 13.81% dividend growth rate, and 8.54% annual appreciation. It's a combination that balances strength, income, and growth, all working in sync toward long-term compounding. To see this in action, let's project how this 3 ETF portfolio compounds over the next 30 years. Let's say Josh starts small, investing just $10 a day. Nothing fancy, just steady consistency. By the end of the first year, he would have invested around $3,650 in total. This sets the stage for future growth. By year 10, the balance is projected to grow to around $65,000, and annual dividend income reaches about $2,000. By year 20, the portfolio is projected to reach $324,000, and dividends climb to nearly $20,000 a year. Reinvested income is now generating its own returns, and growth begins to snowball. Fast forward to year 30, and the portfolio value is projected to reach $1.84 million, and annual dividend income jumps to roughly $187,000. That's over $15,000 in monthly dividend income. Now let's see how this compares to the S&P 500, SPY. Both start the same way, same $10 a day investment, same steady contributions. But as time goes on, the difference becomes massive. By year 10, SPY's dividend income is about $300 a year, while the 3 ETF portfolio pays around $2,000. That's roughly 6 times higher. By year 20, the gap widens even more. SPY's dividends grow to about $800 a year, but the 3 ETF portfolio is paying nearly $20,000, more than 20 times greater. And by year 30, the contrast is hard to believe. SPY produces roughly $1,300 a year in income, while the 3 ETF portfolio delivers about $187,000, a difference of $185,700 per year. And it's not only dividends that are better, the same pattern shows up when you look at total portfolio growth. In the first decade, both the S&P 500 and the 3 ETF portfolio grow at a similar pace, between $65,000 and $69,000 by year 10. That's completely normal. Early on, compounding works slowly. You don't really feel it yet. By year 20, things start to separate. The 3 ETF portfolio climbs to about $324,000, while SPY sits around $305,000. It's not a massive difference yet, but the momentum is shifting. Fast forward to year 30, and that small gap turns into something huge. The 3 ETF portfolio grows to roughly $1.84 million, while SPY reaches about $1.1 million. That's a $740,000 difference, built not from higher risk, but from better structure and steady reinvestment over time. Want to know how to earn over $8,000 in monthly dividend income using 5 compounding strategies? Click the video on screen to find out.